So some couple of questions, differences between futures and forwards, leverage, a past exam paper, repeat 17, where we look at futures. And we'll also look at another one where we'll create the question. I have a lot of X's in here, so I'm going to get you to create this question, and we'll um, answer according to what you gave me, okay? And do you want to start off with a bit of talking about the differences between futures and forwards and so on, or just touch on it, or would you rather go straight into calculations first? What's your preference? Want to get the theory out of the way, or just go straight into
Yeah, if you
calculations?
just start with the theory, I'd say.
Okay, it might be a good idea actually. Yeah, you could get a question on the differences between futures and forward contracts. I don't want to read all of this out because you already have it, and they're very similar sounding because a future and a forward, they imply the same type of thing. So let's understand firstly what a futures is and what a forward contract, refreshing what we did the other day, what they are, and then we can note the differences between the two. Let's start off with a forward contract. A forward contract, whether it's dealing with any financial asset like an exchange rate or an interest rate or a stock or a commodity, what you do is you can touch base with the seller directly or the buyer. But let's assume we're a buyer to keep it simple. So you want to buy euro or you want to buy gold. You would go directly either to the seller of the gold or you would go to a broker, and you would arrange with the seller or the broker to come up with a price for you so that you can buy it sometime in the future. Okay, I know we're dealing with forwards here, but I use the word future and not futures. So we are going to buy gold sometime in the future, like say 4 or 5 months time. We don't need a commodity gold now. We'd like it in the future. You want to lock in a price because you like the price of gold today, or oil or sugar, whatever it is, and you're worried about prices rising. So you go directly to the seller of that asset or commodity, or you go to the broker who's arranging these contracts, and you sign a contract saying you're willing to buy whatever number of ounces of gold, whatever barrels of oil, whatever pounds of sugar or copper. You're locking in a quantity. It's specified for what you actually need, and they will come up with a price for you based on whatever fundamentals that are going on at the moment, whatever indicators are suggesting what the price could be sometime in the near future, and you sign that contract. And irrespective of what the price will be in 5 months' time when you're going to buy that commodity, you are guaranteed the price you had locked into 5 months ago when you signed that contract. So prices could be a lot cheaper in the future, which means you'll end up paying the price that you paying for the commodity for the price that you locked into 5 months ago, which is going to be obviously a higher price, so you miss out on that cheaper price. Or if the price ends up being a lot higher in the future, you're glad you locked in that forward contract because it means that you can buy the asset for a cheaper price. So the key thing to note here, it sounds very similar to a futures, but the key thing to note here is that I stated that you're going to lock in an amount at which it meets the quantity that you desire. Okay, so this is going to be one of the key differences with the futures. Let's park it there for a moment. A futures contract, on the other hand, is one which is traded on an exchange. A forward is not traded on an exchange, by the way. It's dealt with in person with a broker or the seller directly. With a futures contract, you go to an exchange. So you either do it yourself online, or again, you could go with a trading house that would, if you're a client, will activate the trade on your behalf. So with a futures, no one knows each other. You won't know the seller. All it is that whoever's selling contracts, you don't know who they are. You just see the volume, you see the prices they're willing to sell at. It's an open market, and prices fluctuate on what's called a tick by tick basis. So you're going to activate your buy into the futures whenever you want, but the thing is, you may not be able to buy the quantity that you specifically require. Futures are standardized contracts, and what I mean by that is that if you want to buy, say, 100 ounces of gold, you will buy one contract of gold, one futures contract, because one contract is 100 ounces. If you wanted to buy 200 ounces of gold, you buy two futures contracts. However, if you wanted to buy 125 ounces of gold, you won't be able to do it on a futures exchange because they're standardized. You will either buy one contract and risk losing out on not being able to hedge your remaining 25 ounces of gold because you initially wanted 125 hedged. You can only do 100, or you can over hedge it and buy two contracts, which means you're overexposing yourself to 75 ounces of gold that you're not wanting to buy, but you end up having to do the futures. And, and that's why forwards are beneficial, because you can set up the contract to meet your specific requirements. So they're specified to your requirements, whereas futures are standardized and are in multiples like 100, 200, 300 ounces of gold, or in terms of barrels of oil, 1,000 barrels of oil is one contract, 2,000 barrels, and in multiples of thousands there. Okay, I think with copper, we're talking about 42,000 pounds as in weight of copper. Okay, so you can only do that in those multiples. So with a futures contract, let's see how the price moves over time. The prices move, as I said, on a tick by tick basis. So if you have an account with that you're able to view online, you can see live how your prices are changing over the duration of, say, the 5 months if you want to stay in that futures trade. So say, for example, you bought oil futures and they're currently trading at, say, $22 a barrel of oil. And if oil goes up by $3, you'll see that gain in your futures account, okay? Because you can now sell it at 25, having bought it at 22. If oil declines the next day to, say, 19, you'll see your account has moved down from what was previously a high of $25 to now a low 19. So you're losing $6 on that previous high, or overall you're gone from 22 down to 19. And you will see these trades on a daily basis, or what's called mark to market, where the prices are changed or are marked based on market changes. You're going to see those live. With a forward contract, you don't have to worry about the live changes because you've already locked in the rate. So over time, you will only realize whether you made a gain in the futures market if, I'm saying 5 months, if you decide to hold on to the contract, if in 5 months' time, oil ends up going from $22 to, say, $42, therefore, you will able to close out your position because you bought at 22, you close out at 42, you make your $20 gain. And with that $20 gain, what you'll do is you'll take that. So say you bought one contract, that's going to be $22,000 you've just made there, because $22 gain times 1,000 barrels of oil is your $22,000. And you can use those $22,000 to go into the oil market. And at the spot, what happens is the spot price will move in the same direction as the futures market. So spot oil 5 months ago, when we bought the futures at 22, spot oil could have been, say, 21.50, very close to the futures contract. Today, when oil has moved in the futures market to 42, spot oil would have moved in close enough, and we'll just say moved to 41.50. So spot oil has gone from 21.50 to 41.50. The reason why you entered into a futures contract is that you were worried that futures oil prices will rise, and you didn't want the oil today because it means you have to hold it. So you can actually, in 5 months' time, buy oil in the spot market, but you pay $41.50 for it. You use your gain of $22 per barrel of oil and from the futures market to help you pay for the spot oil. And we'll see that example. If you find that too much to take in, the numbers, the explanation, and so on, what we're going to do is later on, and we're actually going to see this happening for some of the examples that we're going to look at, okay? So you'll actually have the numbers on the screen here, and I'll go through that explanation again. So that's just a bit of a detailed explanation on futures contracts, okay? Just a definition. Remember, I'm not necessarily asking you to give me a definition of futures and forwards, but I suppose within the definition, it does help you to clarify the differences between the two of them. So I've only kind of highlighted a number of differences in there between the two. And let's look at a couple of the bullet points that we see here that we've already covered. Futures are standardized. Forwards are not, okay? They're more for your specific, tailored for the customer. They're tailor-made for the customer. They're the forwards. Future contracts are not fixed. Okay, what I mean by that, and I already said it. And remember I said that with futures, they're marked to market daily, or we see them changing by tick value. Mark to market daily just means that whatever futures prices change on a second by second, or what we call tick, on a tick by tick basis, they will be registering in your account as a gain or loss. So you went from $22 to $25, and you will see that $3 per barrel gain in your account on that at the close of the day, or you'll see that live moving towards the $3,000 gain. So $3 times your 1,000 barrels of oil. And the next day, if the price of oil fell from 25 down to $19, you will lose $6,000 from your account. So you see that the futures contracts, they're not fixed in terms of the prices. They're actually changed with the market forces, whereas with the forward contracts, they are fixed. Okay, so forwards are fixed, so you can agree with with the seller or the broker, and they won't change those prices. Another thing is with the futures contracts, they have standard settlement dates. Okay, I have here March, June, September, and December. They're standard dates for futures contracts for a lot of the commodities. Oil is, for example, quite a few other commodities would have monthly contract or settlement dates. So January all the way to December, the 12 months. Some would have maybe a quarterly settlement dates instead, but you don't have to elaborate on that. Regarding the forward contract, the settlement date can be any date that you actually decide with the seller or the buyer. So you know, the forward, it all depends on what you, I suppose, that's not as clear as like as if you can break that contract at any time during the year. But what I mean by that with the forward contract is that on the day where you actually sign that piece of paper saying that you're going to take delivery of oil at a certain price sometime in the future, you have to specify the particular date that you want to go on. So regarding the futures contracts, the settlement dates are usually the last Friday of the month of each of those months, whereas you can, with a forward contract, decide on a settlement date at, say, the 19th of August, for example, whereas the futures contracts might not have the 19th of August available. Okay, it'll push it out, because the reason why the futures are doing this, by the way, but can anyone tell me, why do you think futures are standardized? Why do you think, in terms of the contract sizes, why do you think they have settlement dates that specify not every day of the year, but specify certain times of the year for the settlement? Why do you think futures do that?
Could it be seasonal kind of changes in prices and stuff?
Maybe it's not really what I was thinking of, but it could be. Yeah, maybe that's the background to why they are like that, actually, because it does make sense. Okay, for some of the commodities, especially like orange juice and sugar and that, and wheat. Anyone want to add to it, or
liquidity?
Yeah, liquidity. Could you want to elaborate on that?
Just so that they can be like mass traded, I guess.
Yeah. So think of, I don't know if I mentioned to you before in class, there's and you probably never came across it in economics, but there are what's called tin markets and tick markets. Tin markets are where those goods and services are thinly traded because there's not much demand for them, or there's too many of them, in other words, to choose from. Okay, so if you think about, if there was such a shop that didn't sell all different appliances like Harvey Norman, just imagine there was a shop beside Harvey Norman that just sold toasters. And you walk in and there's like 100 toasters that you could pick and choose from. It's very difficult to sell all the types of models, okay? So like of Harvey Norman, they would sell other things plus a few toasters, okay? They know what they're going to sell more of. So having a tin market, it's very difficult to sell all the different types of toasters in there. Whereas if you minimized it, think of the McDonald's menu. They just have a very simple menu to give you something like 7 or 8 offerings. If they gave you like 100 offerings, they're going to spread themselves too thin. So they sell the most popular thing so that they can quickly sell a standardized burger or standardized fries and so on, okay? And it's like that with the futures markets. If you standardize everything, like we're only selling 100 ounces of gold. we are not going 101, we're not doing 102, 103. And imagine doing that. It's too awkward. If I wanted to buy 102 ounces of gold, I might find it hard to look for somebody who's going to sell me 102 ounces, because someone might want to sell 107. So instead, what we're doing is we're going to be selling in multiples of 100, or in barrels of oil, multiples of 1,000. And likewise, we're going to settle on certain dates, so that I don't come along and I want to buy futures for the 19th of August, but I'm looking around for people who are willing to sell 19th of August futures. And there's no one, someone's wanting to sell a 20th of August futures, but that doesn't suit me. Okay, so we're an 18th of August, and we're finding it very difficult to match up buyer with seller. So that becomes very illiquid. It becomes too thin, and the futures may not operate properly. Let the forward contract solve that problem. The forward contract will solve the 102 ounces of gold, and it'll solve the 19th of August future settlement date in terms of the forward. So let the forward contract solve those problems. Futures markets are highly liquid as a result of that, and there's a lot of trading and a lot of market discovery in terms of the price action. Okay, let's go on. Oh yeah, this is important as well regarding the margin. The margin is to do with futures. So a margin payment is made during a futures contract period. And why is that? Because it needs to cover what are called variations. Doesn't mean the rate of exchange. That's fine if you're dealing with exchange currency, but it can also refer to variations in the price of gold, the price of oil or sugar, whatever commodity we have. Does anyone recall what we mean by a margin payment? A margin, okay, with a futures contract, what it does is with a futures contract, if I was a buyer and say you were a seller of a commodity, we don't know each other. As I said, with a futures contract, we're just numbers. We don't know each other. So how can I trust that you're going to sell me something if I want it? And especially if the price goes up and I had bought at a low price and you were selling at the low price, you were selling oil, and in 5 months, say in 5 months' time, oil ends up being $42, and you regret having sold futures 5 months earlier at 22, that you decide to renege on your contract and walk away and decide to sell oil for $42. Why would you want to do 22? The futures, you don't have an option, so you can't opt out of that, even though we could have done options on the oil contract. But anyway, we're dealing with futures. But the flip side could happen. If I wanted to buy oil for 22 and I entered into a futures contract to buy at 22, but oil fell to $1, say even the next day oil, as we saw, it went negative. But if oil went to $1, and I just locked in a futures contract to buy it at 22. So I can't come along and break my contract and buy it at $1, because the seller's going to miss out, and the seller's going to end up taking a case against me. They'll find a certain way in order through what's called the clearinghouse to do that. So the futures contracts will have what's called a clearinghouse, and a clearinghouse is like a middle person who will take the trades for the buyer and the seller. And I won't be able to buy futures, and you won't be able to sell futures unless you deposit a margin or a certain amount of money into an account that you've set up with the clearinghouse. So say if I wanted to buy 1,000 barrels of oil and it's currently $22 a barrel, I don't hand over $22,000 to the margin or the clearinghouse. I don't add the 22,000 in as my margin. If that was the case, I might as well just buy all the oil. So the clearinghouse would require me to give them a percentage, and it's usually about 5%. Let's just say it's 10%. So the clearinghouse would ask me to put in a margin of 10% of that trade, which is $2,200. They'd ask the seller for the same, and that's piled into our accounts. So when the trading day happens, immediately price of oil will start changing tick by tick. And if the price of oil goes up, I end up with a little bit more in my account, and you end up with a little bit less. So say if oil went up $1 at the end of the day, I will have $1 times 1,000 barrels. I'll have an extra $1,000 in my account. So now my account reads as 3,200, and you will have $1,000 less in your account, okay, which is now 1,200. This is why we have here, it covers variations. In other words, what we mean by that is it covers the changes in the price of the asset, the financial asset we're trading in the futures markets. If it gets to a certain point where the seller is losing more and I'm gaining more, and just say there's a cutoff of say $800, the clearinghouse will contact the seller and ask the seller to top up their account with a variation margin or an additional margin and bring it back up to 2,200. So if the cutoff was $800, they would ask them to top up by another $1,400 to bring it back up to 2,200. And if they can't do that, they'll force them to close out the contract. And there's always a seller to continue on with my one. It won't force me as the buyer to close out because, as John mentioned, it's a very liquid market and there's always somebody there who will offset my trade. So another thing that, I'm just going to jump ahead because there was a question, if you see it, I'm jumping in one to the other, but you could always include this as part of your comparison here. Why are futures described as a zero-sum game? Can you explain what that is? At least we'll have this answered and that can be put into your differences as well.
Be a winner and a loser.
Yeah, winner and loser. I just said it there in terms of the illustration. By the way, if you can, illustrate with examples or with diagrams. Okay, so I've given you plenty of illustrations by throwing in numbers, and that's what I need from you. Don't just be too technical or too textbook in terms of your writing. Put in a little bit of illustration, like making up a number, 2,200 in my account. Same with the sellers. The price of oil goes up by $1. I gain $1,000. They lose $1,000. It's a zero-sum game. In other words, what we mean by zero-sum, if you add up the gain and the loss, it sums to zero. So I gained 1,000, they lost 1,000, plus 1,000 minus 1,000 equals zero. Okay, so there's a winner and loser. Ultimately, I think the clearinghouse will be the winner. It's like the bookie in a way, because they will always get the spreads, what are called spreads, and they earn money on that. So the more people are participating, they can reduce those spreads, make it a bit cheaper for us to participate, but they'll still hope to earn a living from offering, being the broker or being the middle person in that. So you can elaborate on that as part of your differences as well. And sticking with the margin, the variation margin for the forward contract, there's no such payment with a forward contract. Okay. Now the thing is with a forward contract, it all depends on how risky things are at the moment. The seller or whoever's brokering the deal with the forward, or if it's the seller of the commodity, they might actually require a down payment just in case you default. So the margins there are really to protect from or minimize any default issues. And you might actually state in your contract, the seller might state or the broker might state that we need you to put up some money initially, so that if you renege on this contract, you will forfeit this deposit as such. So that could be something, and not necessarily no such payment, but you could specify a down payment. Not that this is true. Okay, credit risk for the futures market is virtually eliminated. Why is credit risk eliminated? Well, it kind of follows on from the previous one where the margin is requested. I don't think this is true. It's probably true if you want to put a probability on it, maybe 99% of the time. But what situation could result in a lot of credit risk? In other words, where there's a lot of defaults.
Recession.
Yeah, go on. Keep going. In terms of the futures markets, related back to the futures, because the recession is more the economy as well, and it does feed in. So think of oil. Use examples for oil. Always think of your examples.
Because US oil is worth nothing at the minute, is it?
Yeah. Right. Just think of the number. Oil was $22. It actually went negative. It fell up by over $50, so it went to negative $37. In other words, they were giving oil away. I think even I don't know what company it is in America, is just releasing a lot of gas into the atmosphere because they've nowhere to store it and there's no demand for it, so they're just releasing it. About a month ago, there was such a buildup of milk that they decided to spill all the milk and get rid of it because they couldn't. So they couldn't even give it away for free. So with oil crashed by $50, which means you have negative 37. It implied that they would pay you $37 a barrel of oil to take it away from them. Okay, so imagine if I was a buyer of oil at $22, and when I woke up the next morning, oil crashed $50 to $37. not only did I lose $22, but I lost another $37. I lost about $50 on that trade within a matter of minutes. Okay. The clearinghouse is going to come after me because it was like a flash crash that the clearinghouse didn't even have time to contact me to say, could you top up by $800? Could you top up by another 800 and keep on topping up? It just happened so suddenly that it went right past my, eliminated my account. A lot more. They're coming after me. I don't have an option to opt out of it. I never put in a guaranteed stop loss, which I should have. Okay, which means it'll guaranteed to stop out my contract at say $19 if it did fall to $19, and they're coming after me for $50 a barrel. In other words, 50,000. They want 50,000 from me. I could have bought 1,000 barrels of oil for 22,000. Now they're looking for 50,000 of me, and I have no oil at all, and I'm not going to pay that. So I'm going to default and just declare bankruptcy, and I'll probably be marked for trading contracts with that broker or any other broker. But a lot of hedge fund companies probably went under with a lot of those trades on oil. Seller would have been great, like so the seller of the futures contract would have sold at 22. They can buy back in minus $37 and make $50 on the oil that they were willing to sell at 22, and they actually can make it. So you can see how credit risk, it says, are virtually eliminated, but it's not always eliminated. Forward contracts, on the other hand, might have some. It says here they have to be wary of credit risk. In other words, are you reputable? Do you have a good collateral? Do you have a good reputation in terms of paying and honoring your contract and not defaulting on it if things go against you and you end up having to pay a lot more for your oil? If you locked in at 22 and you can get oil for $1 now, you still have to pay 22. So if you could walk away from that contract, the forward contracts, people could walk away from it easily, and it might be just better instead of fighting a legal case, and the sellers fighting a legal case might just let the buyer walk away from it because there might be too many of them walking away from the forward contract that you mightn't even be able to fight that particular case. Anyway, there are the differences between the futures and forwards. I spent quite a bit there. Okay, like here was a 5-mark question. It all depends. You can mention all 5. You can mention just 3 of them. If you mention 3 of them, just build on a little bit more. Okay, just give your examples. Plenty of examples to go by. They don't have to be exact. You don't have to know prices. You don't have to know contract sizes. And you can make them up, or you can just be generic and just say contract size.